We're numb, seriously. The performance in our fundamentally superior stocks have been way stronger than normal, and my dad keeps checking his pulse to make sure he's not dreaming. So we brought in a very popular and special guest to help us make sense of what's really happening.
It's an honor to have Bespoke's Paul Hickey back on Navellier Market Buzz. I rely on his charts religiously because they put the market in perspective, and we're going to show you some of his great work today. But let's just dig in here.
It's great, Crystal and Louis, for having me on. I'm really excited to join you again. Love your work and commentary as well. And it's always nice to come on at a time when the market's doing well, right? So let's just hope that keeps up.
Exactly. So Paul, you recently sent out an oscillator showing that the S&P 500 went from oversold to overbought in just a few days. Is that because President Trump basically triggered another taco trade by saying the military action in Iran was almost over?
I think when you hear the term taco trade, I guess it's a good description for escalate to de-escalate. But I mean, if you ask the people of Iran if the president really chickened out, I don't think you'd get many people saying that. So we didn't destroy an entire civilization, but we definitely saw some damage there, and I think brought the Iranians to the table. But I think what the market is very optimistic about here is that, and we're seeing it more and more every day, is a collective sigh of relief that this isn't going to drag on for a long time. Just today, the Strait of Hormuz reopening, that should be, if that keeps up and we continue on this track, I think it really makes sense for the market to erase the losses from February that we have. So it's been a crazy few weeks, but that's on top of what's been a crazy year already. We saw some massive swings from overbought to oversold in the market, even leading up to this war. And now we're riding what looks like a 13-day winning streak for the technology sector in the NASDAQ, where we've seen some massive gains. The technology sector alone, just in these last 13 days, the only times it's seen a larger move in the last 20 years were in March 2009, coming out of the financial crisis, and then in March of 2020, coming out of COVID. So very notable moves. The only difference this time around is that it's happening right at 52-week highs rather than after a deep drawdown.
Paul, you had a great chart showing that high momentum, high volatility stocks are leading this rebound. Do you expect the breadth and power of the overall market to finally expand? Because your chart really said we're in a pretty narrow market.
Yeah, so it's really interesting what you look at. We've seen some narrow breadth in this rebound. We've seen the Mag 7 start to lead. And ironically enough, in the first quarter, the Mag 7 traded as a monolith, or the trillion-dollar stocks, in that they all went down and underperformed the market. So we're so used to 2024 and early 2025 where they all outperformed. We saw some dispersion in the group late last year. And then earlier this year, we saw them trade likewise in like fashion again. And coming out of this rally, we've seen them outperform. But I think part of that is just the fact that there's been a rush of capital into the market. And when people want to get invested quick, they go to the big liquid names. So I do think the rally will broaden out as time goes on, because we saw that before the war. We saw the average stock outperforming the market. Within the S&P 500, there were more stocks up 20% as of the end of the first quarter than down 20%, even though the market was down. So there was there were some big moves underneath the surface, and more of it was higher than lower.
We've got another question on breadth for you. You recently had a great chart that showed the S&P 500 made a new high, but the cumulative AD line was lagging and didn't make a new high. Do you think that this line will catch up?
Yeah, I do think it will catch up. Just following up on that breadth theme, the cumulative AD line for the market peaked on February 27th, right before the war started. So even though the S&P wasn't at its highs, breadth was leading the market, as it has for a lot of this, the last several months. And I think we saw a pause in that given the uncertainty. When you have heightened uncertainty, they rein in their bets, and especially in some of these less liquid names where the fog of war could have a bigger impact. As now that the war seems to be behind us, at least the worst of it, I do think the cumulative AD line will pick back up. One day doesn't make a trend. Call me in 2 weeks, and if the AD line still hasn't caught up, that would be more concerning. But right now, I think it's just a short term dislocation, but it will catch up.
That makes sense. Now, I love your triple plays, Paul. So can you walk us through what makes these stocks so special?
Yeah, so I mean, a triple play, it's a company that has reported better than expected earnings, better than expected revenues, and has also raised guidance. So, we all know at earnings season, it's really easy for companies to exceed earnings and revenue forecasts. They typically lowball so that the bar gets set low. So that's easy. When you have clarity on the outlook going forward, that's more impressive, especially in uncertain times. So this earnings season is almost a microcosm of the earnings season at this time last year during the tariff tantrum. And what we saw then is we went into that earnings season thinking we were going to see very little in the way of companies raising guidance because they had every excuse not to talk positive about the future and rein in expectations given the uncertainty. But what did we see during that earnings season? We saw more companies raise guidance than companies that lowered guidance. And so that was really impressive and was a strong signal. That's what we'll be watching for coming up into this earnings season. And I think we will see some good guidance because the economic numbers have been good. We've seen earnings forecasts rise all year, even during this war. We've seen the banks just reported this week. Loan growth among the largest banks collectively was up 10%. We haven't seen that rate of growth in loans since coming out of the financial crisis again. So that's a positive signal going forward for the economy. And we've seen ISM manufacturing indices, local regional Fed reports come in better than expected. And everyone talks about how bad the labor market is. Employment rate is 4.3% right now. That's pretty low. We're not seeing major job creation, but we're not seeing job losses either. Initial jobless claims remain very low relative to their historical range.
Yeah. I would add that young people like Crystal have a side gig. Okay. It's I've noticed that with young people. So they're working.
Yeah. And I just got off on a tangent there, the triple plays. But these are names we like. So we track these names on our website. We have multiple reports of how we highlight these. And just every day, people can come on the website and see the most recent triple plays. And one of the ones that recently came out that we saw that's really interesting that people may not have heard of is Planet Labs. And they do satellite imagery of the world. And clients can pick any spot in the world and see an updated picture of it every day on a daily basis. And so I mean, obviously, with this war going on right now, you have a lot of interest in the traffic on the Strait of Hormuz. But even outside of the war situation, you have just, for companies trying to keep track of their capital all over the world, see how things are moving, see environmental conditions. It's a really interesting stock. They just turned cash flow positive for the first time last quarter when they reported in March. And they're expecting at least 30% revenue growth going forward for the next 4 years, and they hit their rule of 40 goal a year ahead of forecast. So again, it's not a household name, but that's what we like about these triple plays. You find all these interesting names, and it makes it a little more exciting than just focusing on the mega cap stocks or indexing.
Yeah, when a company goes from negative to positive cash flow or negative positive earnings, that's usually when you hit the biggest home run. So yeah, that work out great.
Now, Paul, you're also famous for the Bespoke 50, stocks that have historically beaten the market. Can you share with our viewers how you actually select these top 50?
Yeah, so I mean, it's, on Wall Street, everyone tries to complicate things, and make things sound overly complicated. I have 4 daughters, so my life is complicated enough. So we just keep this simple. We look for companies that have strong earnings growth prospects and positive chart formation. So we do a quantitative screen of companies based on their growth forecasts, and then we do a qualitative screen going through those names within the Russell 3000. So this is companies with market caps in the trillions to the hundreds of millions. So you get all sorts of companies running the spectrum, and sort of like the triple plays, what you learn is that there's so many different ways for a company to be successful. It's not always just tech that drives the market and drives the gains. You can find really successful companies and business models outside of tech and in some really arcane fields. So again, we were just talking about Planet Labs as far as one name in a different, looking at the triple plays, but in the Bespoke 50, there's a lot of growth names where you get a lot of household names and a lot of non-household names.
I should add, outside of the data center stocks and the AI related stocks, which are clearly the leaders, where are you seeing the market strength other than Planet Labs?
Yeah, so I mean, I think two sectors that we find interesting, one longer term, one shorter term. First, let's go longer term. Some of these industrial stocks, some actually have ties to AI as far as infrastructure for data centers, but the reindustrialization of America, we're seeing more and more business coming to the United States, not just because the president is encouraging it or giving a strong hand towards it, but also because the US is energy independent. Companies can come into the US, locate in the US, and know that they have a very safe energy infrastructure in place, and they'll be able to get energy. So that is a positive there. And in the short term, everybody's talking about how terrible the consumer is. Michigan sentiment just hit an all-time low. Consumer numbers, again, we were just talking about employment before. It's holding up well. And as you were just saying, Louis, before, most of these young people have a job and a side gig. So I don't think the consumer's in as bad a position as we tend to make out. And so coming into this earnings season, we've seen analysts lowering forecasts on some of these consumer stocks because of higher energy prices are going to hurt the wallet, but energy is only about 3% of the average consumer's account, according to the JP Morgan conference call this week. And so I think you can see an upside surprise there. And as far as the more individual names, you look at some of these restaurant stocks. You have a stock like Starbucks, which is experiencing a major corporate turnaround. But if you start to see a better consumer picture, that'll only be another added fuel to that stock. And then we also a name we like is Shake Shack for a longer term play. We've liked it as a longer term growth stock. It got hit on some of these consumer trends and inflation, but we think the worst of that is behind it, and we're going to start seeing a better backdrop for that stock in the future here.
That's great insight. You know, our stock grader system we tested at the end of each quarterly earnings season, and the last test showed that only the top 10% was leading the way. But then we also have an 8-factor fundamental model that said, well, the top 30 there are good, so 30% is good. It should broaden out. As we talked today, you know, the Russell's beating the major indices. So that's a good sign. And of course, small caps are more domestic. And so and the U.S. economy is better than everybody else. So that helps a lot. Also, I noticed that I think we have a 9.5 trillion of foreign investors in our treasuries. That's an all-time high. So clearly they're putting their money here.
Yeah, so much for that Sell America trade, right?
Oh yeah. Well, you saw what Trump did in Davos. He just walked over there and says, better follow us or you're a loser. No.
And they did.
Yeah, and I was actually talking to a gal that was at Davos, and it's not going back. They think it's going to Dublin, Ireland, but it's follow America or be left behind. That's the policy. I love the fact that all the oil tankers are coming to the Gulf of America to get the fuel, you know?
Oh, yeah, as Trump said, we have plenty of crude and it's the sweet stuff, as he says, right?
That's right. And he also controls Venezuela oil. And of course, we could control Guyana through Exxon, because Guyana is still a very exciting place. And it's going to be interesting. I don't know if this is part of the master plan, but it's where we are at this moment.
It's really interesting because, you know, we talk about the market hitting new highs. You see this divergence between consumer sentiment and you see how the market doing well. But, you know, you just look at the headlines. If you took the paper, I was just looking at through the New York Times, you know, biggest mainstream newspaper, since March 30th, if you look at it every day, every headline about the Iran war is negative, talking about how it's going to cause major disruption in the economy, and it's going to cause problems. But every day the market's been up since March 30th. So it reinforces this point that we tell people all the time. If you're going to be an investor, the last place you should be looking for any sort of insight is on the front page of any newspaper, because all of that is news that the market has priced in weeks or months ago.
Yeah, I agree. And, you know, thank God we're in earnings season, because we've had the strongest analyst revisions, not me, the whole market.
Right.
It's had the strongest analyst revisions in 5 years. And now the earnings are just starting. And, you know, we had Taiwan Semi lead the way, and it's going to get more exciting in the next few weeks, even though we've already surged. So I think it's going to be a lot of fun. So I'm looking forward to it.
Isn't earnings season always fun, good or bad? It's very
It is
exciting.
fun. It is fun. NVIDIA is always the grand finale. And then I
Yep.
always have to explain to people why NVIDIA doesn't go up when it has incredible results. And it's usually due to the option writing. And I call it the tail wagging the dog, but,
Right.
but obviously NVIDIA is running right now. And so it just got a head start. But, I can't believe that stock is still accelerating sales and earnings momentum. And they had the conference and they're going to be accelerating next year. And there's going to be a replacement cycle because the Vera Rubin's better than the Blackwell. So, I mean, it's just,
And even
it's
the
hard.
older chips, the rental
Oh, yeah.
rates are still, people are still clamoring to get their hands on some of the older chips for
Yeah.
computers.
And there's a need for speed. And it's just everybody's upgrading. And, data centers are over 50% of the construction in America right now. And it's just unbelievable. It's going to be fun to watch. My only concern is next year that I think the year-over-year comparisons will be getting tougher. But all this year, it's earnings nirvana, for lack of a better word.
And to the point about NVIDIA, it's moved sideways for the last, it's rallied over the last couple of weeks. It's still where it was late last year. And what's really interesting about that is even though it's the largest company in the SOX, Philadelphia Semiconductor Index, by far, even though that's been sideways, the SOX is up about 40% over the last 6 months. So for all this talk about how, it's only a handful of stocks driving things in the semiconductors, which we consider like the biggest leading indicator for the broader market and the economy, there's been some very strong participation in that area of the market.
Yeah, that's great insight.
So, Paul, just to summarize for our viewers, the three stocks that are on your radar right now is Planet Labs, Shake Shack, and Starbucks.
Yeah, those are three of them. I think it is within our Bespoke 50. A recent name we added was Airbnb. I think in Airbnb, some of these platform companies that you talk about, Airbnb, say an Uber or Shopify, they've sort of gotten thrown out with the rest of the software stocks on the AI disruption theme. But I mean, these platform stocks are a lot more than just a website someone slapped together and brought people together. They have very strong network effects. It's not going to be an AI bot that's going to really terminate their business models. And Airbnb is trading at a market multiple for, better than market growth. So that's a name that we find pretty attractive at these levels, I would say. And then, but throughout that Bespoke 50, there's just, I could go on for hours.
No, that's great. I also have to share that my dad recently told Maria on Fox Business that he would be disappointed if he wasn't up 60% this year. A very bold claim, but I can say that he's almost halfway there with his growth investor stocks. So with that being said, do you think this year has the potential to be as good as 1999?
And that would be something, right? I mean, Louis always restrained, right? Like in your expectations, 60%, that would be amazing. But what I really find fascinating is we've been making this comparison for several years now, comparing the launch of ChatGPT to the launch of Netflix, because ChatGPT was to AI what Netscape was for the internet. It really brought it mainstream. And the parallels and the comparison of the NASDAQ from the launch of Netscape to the launch of ChatGPT, they've tracked each other really closely, even going this far out. And what's really amazing is that if you overlay the comparison right now, we'd be about like early 1998. So just on that comparison, you would say we have a lot more to go. Could be a rockier road, especially if you remember 1998. But what's really fascinating is getting back to that media conversation we had is even in 1996 and 1997, you look at the headlines, when the market was hitting new highs, you constantly saw headlines that we were in a bubble. And then when we pulled back 5%, the bubble had burst. And every time you saw a pullback, you'd see headlines that the bubble had burst. And then we kept going. So I think there's probably more gas in this tank here as far as percentages are concerned. I don't know, but I mean, I think we do have a growing economy in the backdrop here. And it is a midterm year. Midterm years can be shaky, but we all know the president's going to be doing whatever he can to make the economy look as good as possible heading into these midterms.
Yeah, no, he's going to be running around on doing Howard Lutnick's job and basically cheering on America, and Howard will be there too, I'm sure. The one thing I would add is Micron trades at 6.5 times forecasted earnings. Nvidia's at 15 times forecasted earnings. But when I do small cap, my whole portfolio's at 4.9 times forecasted earnings. So, the people can argue we're overbought near term, and your oscillators are going to be showing that soon. But the valuations are there because when you have good earnings, it shoves the P ratios down. So, that's been a nice development. So
the PE ratio, and getting to your point earlier, we were talking about earnings revisions. PE ratio has come down not just because prices come down, but because estimates have gone up.
Exactly.
Well, thank you so much, Paul, for joining us. I know our viewers greatly appreciate all your insights and your stock picks.
Well, so thank you so much for having me, Crystal. It was great coming on again. And thank you, Louis, for having me. It's always great to have a conversation. Look forward to hopefully doing it again some other time soon.
Well, thank you, Paul.
Thanks.
I hope you enjoyed this conversation as much as I did. If you did, please give this video a like and subscribe if you want more videos from us. As always, Paul's links will be in the description below. We are also still doing our 10,000 subscriber giveaway, where you can get a free signed copy sent to your home of Louis' new book. So if you'd like a copy, please fill out the form in the description, and also I will put it in the comments. We want to thank you all for supporting our channel continuously every single week. So this is our gift to you. Stay tuned tomorrow with an extra video with Paul, where we'll be going over all of the earning announcements this week. Thanks so much, everyone.